You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the aforementioned network. If we sound a wee bit different, it's because we're not coming to you from our studio in Chicago today. Nope, we're coming to you from the Options Industry Conference here in scenic and sunny Florida. And I'm joined on the show by an old friend of the network. In fact, he's been on so many times, he has his own nickname. He is the Flowmaster, Mr. Henry Schwartz from Trade Alert. Henry, welcome back to the show, sir. It has been too long.
Thank you, Mark. I'm always happy to join you. I think you do great things for the industry.
Stop it, sir. I am blushing. I am blushing indeed. But we like to have you on. This is a good stomping ground for you every year because you always do your state of the options industry at this conference. And it's an interesting state at this time of the year than it was perhaps compared to a year ago. So let's start there. What are some of the interesting data points? You guys obviously over there at Trade Alert and Option Alert have your fingers on the pulse of all things options data. What are some of the interesting things that are standing out to you this year as you give your state of the industry address?
Well, I mean, it's a really good point. It's a very, very different year. I mean, I've done this, several times. And volume has been relatively flat for the last few years at a healthy level, 4 billion contracts a year for OCC. But, after first quarter of this year, we're actually on track for somewhere between 4.5 to 5 billion contracts. So I don't want to say it's going to be 5 because that's a pretty rosy forecast, and that the first quarter is an outlier. But I think that there's a very good chance we see an all-time record. The all-time record was around 4.6 billion in 2011. And so it's volume and it's volatility. That's really the theme of this year for sure. Market quality also is a kind of a big issue. There's been some stories in the press. And I think,
of heat.
Yeah, and it's not as hot as the VIX debate, but the market quality is concerning. So the theme that NASDAQ assigned to this year's conference is, I believe, Reinventing Tomorrow. And initially I thought that was kind of cheesy, and then I started thinking about it. I was like, what, actually I kind of like the concept of, we got to think about the next few years, and as an industry say, okay, you know what, so we're down to a handful of market makers. We were just talking about it. Is that a good thing, or is that a dangerous situation? And what, really look at it and try to figure out between all the participants, exchanges, banks, prop firms, and liquidity providers, what is best for kind of everybody.
It's funny you mentioned the liquidity. I think in part maybe because of that journal article. That definitely is getting top of mind with a lot of our audience. In fact, we asked them before we came down here, what do you think should be top of our agenda when we come to this conference and we talk with everybody at the conference? Should it be crypto options? I thought that would get a lot more love than it did. Should it be something like after hours for options traders, something I know it's a common concern, particularly for the retail out there? Or should it be something like options liquidity issues or some others? We've gotten some very interesting alternative suggestions. But right now, with a couple days left, it's got about almost half of the people saying options liquidity issues. So this is obviously trickling out there to the masses, Henry. I know you typically break down the industry. In fact, I always cite your number you gave, I think it was last year or the year before, where about 19 names accounted for somewhere around half of the volume in the business. How are things shaping up this year in 2018? Are we still that concentrated? Is it getting even worse in the top, say, 20?
It's very consistent. The numbers I ran for this year's slide on concentration, it's about 3% of the names are doing 80% of the option volume. So that leaves around 4,000 names that all together make up 20% of the flow. And this debate, it's kind of circular, right? You have the liquidity providers that will weigh in on it basically tend to say, well, if there was actual volume trading, we would tighten up our quotes, but nobody wants to make a tight quote in a name that's so thin that the only time that a trade shows up is in a rip your face off type of trade. So they just stay wide, and that's really exacerbated by the price improvement auction component of the market. which is a big piece, and it clouds things up because we look at the data and we can basically say on any option contract, here's the quote, right? It's 50 cents at $2. It's an untradeable market. You'd be crazy to try to trade on a spread like that. However, we also can see what the statistical likelihood of trading at an inside price is. So if something's 50 cents at $2 and it happens to have a theoretical value of 90 cents, we have enough history to say, this actually usually trades about 6 cents around. And so there's this kind of inside market, but it's not accessible to everybody. And that's a problem. And that really is, the optics are bad too, right? Because, if some new customer, somebody coming out of grad school who's very smart and has an interest in derivatives says, I think thinking about trading these options, and then they look at it and they're just turned off instantly by a bad advertisement. And it's hard to communicate to the masses. It's 50 cents at $2, but there's a very high likelihood you're going to be able to trade 95, 105. And that's a problem, and nobody's really come up with a great solution for it.
It's interesting. That's kind of a question I've been asking a lot of people here for a couple of years now, and I'm continuing to do it this year. Auctions seem to be a very polarizing thing. Some people think they're the best things than sliced bread, and you could see how they were launched with good intentions. We're going to talk a little bit about the dwindling number of market makers out there. This was kind of conceived as a protection for them. They don't have to show their best hand, so the rip your face off paper won't be perhaps as scary for them. But on the flip side, they're not. Guess what? They're not showing their best hand as a result. So you mentioned, the quotes are advertising. It's kind of a bad advertisement right now for the options business when something is several dollars wide. You're not even going to bother working the order. It's just going to discourage you. So it sounds like you fall in the anti-auctions camp. Is that fair, sir?
I fall in the let's curtail this a little bit camp because the auctions are. I think it's a issue of kind of unintended consequences that. I don't know how well thought out they were. If a quote on a screen is, 110 at 120, it's easy to say, well, gee, let's do an auction between those prices and let people even tighten up more. The problem is, that was kind of how things started. And, I believe around 2009, the rules were changed to actually allow the auctions to take place from the bid to the offer, not just inside the bid and the offer. And that was, I know the exchange official who got that rule passed, and he looks back on it and says, that probably screwed things up because if you're a market maker, like you used to be, and you're like 110, 120, 100 up, and you see things trading at 1, at 110, and you're not getting to participate, that's frustrating. All you're going to do is widen out your quotes because you're giving away that information.
There's no point. Yeah, if you're going to be on the bid, you're taking risk for no reason. There's no point. You might as well widen out. It is interesting. You mentioned, just in general, what a difference a year makes. Like I mentioned, it was a very depressing conference last year. This year, much more upbeat, as you mentioned. We're up somewhere around close to 30% here for options volume so far this year. Last year, VIX was anemic by any measure of the word, and it was continuing its downward trajectory for the rest of the year. This year, VIX came roaring back to life with gusto. So a lot of people like to talk about volume at this conference. You're the man with a lot of the data. I'm curious, do you think this, obviously we're off to shall we say, a robust start to the year? You think this is sustainable? I don't think we're going to end the year up 30%, obviously, but where do you think we'll cap out the year? 5%, up 10%? Maybe you think we'll be unched or down? What do you think the rest of the year has in store for us here?
My projection is up about 12%, actually. So I think it will persist. I mean, we saw, February was the kind of the climax of things, but it did carry into March. And, we're still seeing, with VIX hanging out in the 15 to 20 range, you get much more kind of, two-sided activity, right? Last year when things were just so quiet, and, volume actually was pretty good for a quiet year, and we actually did, uptick from 2016. But one of the brokers I talked to said, my customers that are, long options can't make any money because nothing's moving, and my customers that like to sell options can't justify to their boss selling volatility levels that are so low, even if that was, tended to be the profitable strategy most of last year. So he didn't have any trading. There was no activity. Now you're back into the point where, you have people betting on volatility whipping around. We're seeing a bigger uptick in single stock activity too, which is nice because ETFs really were kind of growing and growing at the expense of single stock options, and what we're seeing now is that's turning around a little bit. The single stock is actually heading back towards about 50% of the market.
That's interesting because you're right. The ETFs for a while there were just taking up all the oxygen in the room. You couldn't really talk about options without talking 60, 70% of the flow going to these ETF products. It's nice to see the single stocks taking a little bit back from the ETFs. It's interesting. Actually, it's good timing that you're on the show right now, Henry, because I was just talking about you not too long ago. Someone brought up on one of our shows, we had a listener question about they were looking at a chart from, I think it was from FT, showing how much growth there has been in the S&P over the last decade in terms of last 30 minutes of the day volume. It's up to, if you include the closing auction now, it's up to somewhere around 25%. This is just underlying. This is not the options. Just underlying. But they're asking us, is this a good time to be trading options around the end of the day? It used to be only pick-off paper. You got the hell out of Dodge at the last 5 or 10 minutes of the day because that was dangerous stuff. But I thought that would be a good question to put to Henry because he's a man with the data. So you are here. I will put you on the spot now, sir. But I'm curious, what are your thoughts there? Obviously, you can't just take the S&P data and extrapolate it to a Walmart. But in general, are you seeing a lot more options flow end of day? And has that become, shall we say, a little bit more liquid, less scary time of the day to trade for people?
Well, we do calibrate for the purposes of our weighted unusual volume alerts. We actually do every day average in the slices of the market that's trading per minute. I haven't actually seen the option flow change in that last hour, but that first half hour of the day is a kind of a terrible time to trade. There's so little going on. There's a lot of people that are quoting wide. I think they wait for the 10 a.m. numbers. Or they just, nobody wants to be first, right? So, we see, the typical signature is, a very quiet, first half hour you want to stay away from. Things tend to be good from about 10 Eastern time to 11:30. Then it gets quiet for lunch again, and then the last 2 hours are busy again. So, I can look a little bit closer at, maybe even the last 20 minutes of the day. I mean, it's an interesting question because I would assume that the underlying stock volume is tilting that way because of just more and more VWAP and algo-based approaches that are recalibrating to get some goal accomplished by the end of the day. And we have seen algos get into the option space a little bit. It's most approaches I don't think work very well. But it's possible that you're seeing a kind of a Vega VWAP or something where there is some end-of-day goal that has to accelerate for the last hour. So I will look at it and let you know.
There you go. See, listeners, ask and you shall receive. I thought you'd be the man to. I was extrapolating, but I knew you would have the data somewhere at hand. Speaking of data, you mentioned the VIX controversy a little bit earlier. I recall, I think it was a long time ago, probably about a decade ago. You and I were on a panel together, maybe close to 10 years ago, in New York, on talking about all things volatility. At the time, we were talking, and you had some interesting data in hand about some interesting puts that were going up in and around, VIX settlement. At the time, it was kind of like an offhand thing. I think you and I remarked it was somewhere had spent, a decent amount of money, somewhere not a ton, like around $250,000, something to do some puts that seemingly were worthless. And it seemed like a very inside baseball conversation, and we talked about it. It was interesting fodder for the panel. And it seemed to kind of maybe have its heyday for a while, then kind of go away. And obviously, it's back with a vengeance, at least in terms of the public perception of it. There's a lot of coverage of it out there these days. Big articles, the Journal, others are actually going after this product. There's been all sorts of conversations about it. I'm curious. You obviously watch the space. You have a lot of the data over there. What are your thoughts? I mean, even the most recent settlement, for example, we got a lot of questions about that one. It was all over the place. There were a lot of puts that I think going up that probably could charitably be termed to not have much value going up around that time. I'm curious, have you been watching this more, given all the heat of late, and what are some of your thoughts on the swirling controversy these days around all things VIX settlement?
Well, I mean, it's interesting, and I do remember, we've watched that hybrid opening special settlement, the Haas settlement, for years, because it's a very interesting strip of options that trade. And I remember watching it, obviously, a 1,400 put needs to trade cheaper than a 1,500 strike put, right? But in that settlement, sometimes you'll see inversions. You'll see that put spread effectively trades for a credit, right? The 14s might trade for 20 cents, and the 15s for 1,500s for 15 cents. And I remember asking somebody, why the heck don't they just buy twice as many of the 1,500s? This is insane. And it was a trader at a bank. He said that's not what we're getting here. We are replicating this strip, right? We need the entire range of strikes, even though obviously 1,500 puts are going to be worth more than 1,400 puts no matter what happens. That was not the point. The point was they need the full strip of options. Another trader that I know, a Russian, very smart Russian guy, who trades VIX, I asked about, and he said that it's just a feature of the product. This is how it works, and anybody that doesn't understand how it works should not touch it. So, I don't want to make any enemies. The settlement is definitely a messy situation. I remember SIBO saying years ago when there was a funky print that they were doing everything they could to pull in more participants, right? Because it's not that whole SPX pit that is participating.
It's definitely a liquidity issue too, yeah.
Right. So, they need more. They need people like me to say, well, this is crazy. I'll sell the 1,400 strike at 15 cents because I'm going to buy the 1,500 strike at 15 cents. So they don't have that because they don't have enough people participating in that auction. So I don't know if there's, and I'm pretty sure that's what they're gonna redouble their efforts to get more people to participate because, I don't know, SPX is still a big crowd. There's a lot of capital and a lot of smart people in there, and I think some people are just saying they don't want to be there 20 minutes before the open to try to start quoting. That's not what they do, but they kind of have to, and like maybe maybe CBOE needs to force them to, or kind of change some incentives because it is a situation that the potential for abuse is there. Whether or not people are doing it, I really don't know.
It is funny because for all the heat around this issue, and it is very hot, you're right, it is very simple to avoid. Just stay the heck away from the settlement process. Close out or roll.
Right.
And that's something we've counseled on VIX for years. That's just a rational approach to the product. So for all the heat, the number of people actually being impacted by this is pretty small. But the optics are clearly not good. And that's something that, of course, people want to address. I think maybe I smell a new report coming out of Trade Alert in the future, a new product, maybe some sort of VIX settlement report over there at Trade Alert. People would probably sign up for something like that, especially these days. I think it would get a lot of heat over there.
Okay.
There you go. Speaking of new products, you guys are always rolling out cool, interesting new stuff. What do you think is, or you would know, what is coming down the pike? I heard a little birdie whisper earlier that maybe you have some press releases coming out of interesting stuff our listeners might want to know about.
We did. It was a busy year for us because we got off of AOL at the end of last year.
Yes, I know that was a rough transition for you, sir, clinging to AOL.
We'd been on AIM for almost 15 years. The market had been using AIM for 20 years. As much as it was not a business product, it had the critical mass. That's what the brokers were on, and that's what the biggest traders at Goldman Sachs were using AOL Instant Messenger to talk to their brokers. That all went away. We ported our system into the professional IM systems, which are tend to be ICE, IM, Pivot, Symphony. That kept us very busy, and but it also it lets us be in front of a pure financial audience, which is really great because with AOL, we had the same issues everybody else had with AOL. It wasn't really secure. It wasn't really a business tool, although we had business access to it. And things like Pivot and ICE and Symphony, they're designed for financial services. They're more compliant. They're more secure. So that kept us busy last year. And then this year, what we just rolled out for this conference is a funky niche within our niche, which is the identification of these reverse conversion trades in real time from the data coming through the tape. And I'm not going to bore your listeners with understanding what it is, but it's basically a stock loan transaction surfacing in the options market. And this adds to, we already were processing and figuring out real-time vertical spreads and ratio spreads and condors and butterflies and calendars and all this kind of stuff. This is the first thing we've done where we're actually connecting the stock to the option trade. So to be able to say, okay, here's a borrow event in in Tesla, which is interesting information. It's useful for people that are short Tesla trying to understand what rate they should be paying. That's what it gets us. But in addition, it starts us down the path, and the next thing to come out is going to be just simple stock legs tied to outrights, right? So, in some places, some exchanges, they're identified. Like the Philly will mark a trade tied, and at least it's tied to some stock somewhere. Some exchanges don't. And so to have our system kind of intelligently figure out, okay, well, this block of 90,000 shares matches this, this 1,500 lot of puts, and present that in real time is pretty useful because you're looking at order flow, you're trying to make sense of it all. You see a put purchase and you're like, oh, that looks a little bit bearish, and then you see that it was tied to stock. And before kind of us doing this, people that would do this all day long, they know what to keep their eyes on. They recognize it. They can say, yeah, that print on the Midwest goes with that block of options. But it's the next step for us, which is simplifying even the more complicated stuff. So it's very exciting, and it is pulling in some users for us, from the prime brokerage space. The guys and girls that set stock loan rates. It's a funky market, right? Like, I want to be short some GoPro, hard to borrow name. What are you going to charge me overnight? And it's all over the map. Some places, maybe it costs you 8% annualized. Some places it might be 20%. There's data points that we're able to get out and say, oh, well, you know what? Here's an event, an execution that shows a 6% borrow rate. And therefore, you could go trade the RevCon if you're getting charged 8%. You don't want to get charged 8%. Or you can just use that information to know, okay, 8% is a little too high. 14% is way too high. So that's what we just rolled out, and it's really pretty cool.
That stuff is certainly fascinating for us. We do obviously a lot of flow analysis on what we do in a lot of our programs and things, and so to be able to highlight a RefCon, for example, that would just at the very least let us know that we can avoid that one when we're looking at some sort of analysis. You can always reasonably intuit when a RevCon's going up, but sometimes it's nice to have that in front of you. And then B, the tide legs I think for us is even more valuable because that's something, again, you can usually reasonably intuit that stuff, but it's legwork. It takes time. You got to sift through the volume of data. Sometimes the stock doesn't go up at the same time as the options. You have to kind of make some sort of logical leaps there. Is this stock looks like it's delta neutral? Does it really line up? So something like that where you can identify more of that, I think that's fantastic stuff. So well done, sir.
Thank you.
Well, you got the state of the industry, you got the new RevCon alerts, you got a lot of stuff cooking over there in Trade Alert, it sounds like, Mr. Schwartz. Anything else we didn't touch on that you want to leave with our audience? Maybe some interesting little data points you found while looking at the data this year, or anything, other little nuggets you have up your sleeve over there at Trade Alert? Sir, now is the time. The floor is yours.
The only other thing that I'm going to mention that is important is, is looking into the challenges that the liquidity community is facing. And I was contacted by two different market-making firms about the current kind of capital requirements to be a market maker, which are somewhat insane in the way that it was explained to me. And it's not just a risk-based haircut, okay? The way they explained it to me was there's a notional component to it. And this is a Fed rule which the clearing firms are imposing on option market makers. And what it means is if you're long, 1,000 SPX vertical spreads, 5-point spread, you're long it for 30 cents. It's just a very simple trade. It has positive risk expectancy. There's actually a big notional capital requirement for that trade, way beyond the risk, which is just the premium that you've laid out. And this is another kind of, headwind on the liquidity side of things, which is, in fact, on February 5th and 6th, the two insane days, this firm told me that the fact that that the capital requirements were a little bit didn't make a lot of sense actually contributed to the blowing out of markets in that afternoon. So, and I mean, the data, one slide that I'll send to you shows the data and shows the bid offer on a SPY straddle going from $0.10 to $3 at around 2:30 in the afternoon, and that's a problem.
Yes.
So, and the world did not end. It was temporary, but that's that's a kind of black eye that will blow some people out and turn some customers off forever.
Yeah, that kind of thing is something that. And I've heard that quite a bit from different market makers saying that the restrictions or the requirements are just draconian now. It's nothing to do, like you mentioned, nothing to do with the risk, nothing to do with your exposure. It's just some absurd notional calculations. So they're having to tie up millions of dollars in capital for spreads that are have nowhere near that risk. So on top of all the other things we've talked about with market makers, the costs, we didn't even get into the 16 exchanges that are soon to be part of the business. So you have the fragmentation, the costs, the risks, all the other things that are going on. Now you have to deal with these absurd capital requirements. It certainly makes you wonder, and certainly we're not seeing a lot of them, who would even get into this business afresh in 2018? You can certainly see why the market maker trend has been to the downside rather than the upside.
Absolutely, and and the other thing is there's only 2 clearing firms left for market makers, and so there's not a lot of competition there, and there's concern from the market makers that you could end up with just one, and then there's that's a monopoly on clearing market makers, and that's a problem.
It's funny, I used to be in the pit, you guys probably had the same thought. You always used to joke, oh, how great it would be if you were the only guy in the crowd, because then you can make it as wide as you want, you got all the flow, and it would be some sort of idyllic liquidity paradise, and then profitable paradise too. But fast forward to, we're in a scenario that isn't that far removed from that now. We have 4 or 5 large specialist firms that are really kind of dominating most of the flow. And if you talk to a lot of them, maybe outside of Citadel, but a few others, you talk to a lot of them out there, they're starting to say, yeah, we wish we had a few competitors out there, just to help lay off some of this risk. So it's getting to that point now where even they're starting to say, well, maybe we need some other players in this space. So hopefully at conferences like this and other events, some of these things we're talking about, the capital rules is a clear one that needs to be addressed. But some of these other issues we could talk about, maybe the impact of the impact of auctions and whether that's been negative or positive can finally be hashed out, and we could start maybe making some concrete steps towards bringing some more players into the space from a liquidity perspective rather than less. Well, thanks for catching up with us, Henry. We always like checking out your state of the industry, and we'll look forward to seeing the RevCon alerts and all the other cool stuff you guys have cooking at Trade Alert, as well as, of course, What's Trading, the sister site over there, too. A lot of great data over there as well for the retail folks. So check it out over there, What's Trading and Trade Alert. And, Henry, we'll see you back on the network really soon.
Thanks, Mark.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.